Good morning and welcome to the Saxo Bank Morning Call. It is Monday, March 11th, 2019, and I suppose the first order of business is wrapping up what unfolded late Friday with the U.S. jobs numbers. We had a pretty mixed report. I think the focus, for whatever reason, was on that very weak because it was the large surprise, the very weak non-farm payrolls change. I've got a chart here. You can see it on the right. This plus 20K versus the usual sort of plus 170, 180 expected. This was very ugly. There was a very small positive revision to the prior data, but still, this is a very ugly print. Although you can see we have sort of printed around this level a couple of times previously, back in 2017 and 2016. And then on the more positive side, if you look over to the left, you see that rising line at the bottom, the black dots, that is the participation rate. And it's good news if the participation rate is increasing, because it suggests that people are getting motivated to come back into the labor force. And you'll notice, well, the two other lines showing near cycle lows and even at cycle lows for the so-called U6, most broadest definition of the unemployment rate, at that cycle low of 7.3%. It's only been lower than that for a few months back in 2000. So we're talking about a mixed report. If we look at average hourly earnings as well, which are not on the chart here, they did print at a cycle high. However, that was flattered a little bit by one of these random fluctuations in the average weekly hours. A tenth of an hour drop there means that the earnings level prints higher than it would otherwise be expected. So all in all, what it led to was a lack of a further bid in the dollar, which was rather important because we had just broken lower, for example, in euro-dollar. So we're still coming into this week with some uncertainty on the direction in the dollar. And I'll get more, I'll have more on that later. But Ola, for now, I wanted to, you have this late Friday COT report that comes out showing the positioning across commodity space. Yep. There's also a big grains report on Friday. What's the wrap up there for coming into this week?
Yeah, we finally got the COT report back after several weeks or almost months of delays. Let's just take a look at the table here. It's a little bit confusing. There's a lot of numbers, but we will publish a report on home.saxo within the next couple of hours. But what we basically, the takeaway from the long list is basically that the net exposure from hedge funds in commodities has hit a 3-year low. So we've seen continuous selling, especially of the agricultural space, over the past few months. These are the bottom half is all related to agriculture, and especially the grain space has been hard hit. Corn especially, you can see there was a big amount of selling last week ahead of the COT or the grain report on Friday. It was on numbers. It was a bearish report, especially for corn. There was stocks were raised by more than expected. But I think also we have to say that a lot of this has been priced in already.
And just to highlight on your chart there, that's one of those, the corn positioning is at minus 100%, meaning we're at the lowest, or the largest net short position there's been for your look back period, yeah? It
is, absolutely. I think it's actually, I've got it here, it's low since 2016. So we should just be aware of that especially with keeping an eye on the dollar over the coming days, that we've seen this dollar strength on Friday. If that fails to materialize, there are a lot of shorts in there which make take some comfort from a potential weakening of the dollar.
But fundamentals are obviously very bearish, and that's how
they are.
That's the
reason why we're here. And but it also means that there will always be some pocket of opportunities. So take a look at the table when it comes out, and just use it as a radar, as a guide for some of the markets where you see if something gets too extended to the sold side. If there is a technical or fundamental change, then we could have some fireworks.
Okay. So if we look at our charts of the dollar, I'll run through a couple here. Euro dollar, again, there was that post-ECB reaction where we dropped below the 112.17 level, I believe it was, and even below 112 briefly. There's not been follow-through momentum, so I think it's really important for the outlook here. We can see that we've sort of crept slightly back into the range. I would argue as long as we're below 113, maybe outlook for a continuation lower, but I'd certainly like to see some momentum coming back in here to have a constructive dollar upside view. We've taken profits. We argued we had positioning in euro dollar, both partially in spot and in options. Looking at taking profits on the option side already on Friday morning, and we have still an open euro dollar short, but our stop is rather close here. So we're ready to give up rather quickly because, again, we've been seeing so many of these treacherous churning range breaks that don't materialize into a trend. If we look at the dollar yen chart here, we can see we're at pivotal levels. We've dropped back below the 200-day moving average, and I would argue locally this 111 area, which I've sort of defined loosely with that horizontal line. Rather important. You can see kind of a channel formation as well. I would say further downside here would be associated with bond yields continuing to drop, and weak risk sentiment. And speaking of risk sentiment, important here to note that last week was the worst week for equities since that big comeback from the late December lows. So looking locally here like it's rather pivotal. We have a big witching this week as well, it being the contract month for futures, etc. So we've got that big line in the sand there up above 2,800 in the S&P. And then if we look at single stock stories, there was a very dramatic over the weekend with this terrible Boeing crash in Ethiopia, and Ethiopian Airlines crash of the 737 MAX model of Boeing aircraft, and that is the second crash of this particular model inside of 5 months. And there's considerable worry that this could lead to a global grounding of 737 MAXs and, of course, an impact on Boeing stock. China already ordering a grounding of its 737 MAXs in its country. So if we look at Boeing, we can see here a chart showing on top that's the U.S. listed share, amazingly all the way up to new cycle highs, unlike the broader indices, and some 50% up from the bottom. And then the lower line there is the German listed Boeing share. So if you track that one, it's important. I think it's also important for not just sentiment, but also the Dow. This is a Dow component and could affect the Dow Jones Industrial Average as well. Finally, on the currency front anyway, we have Norwegian krone strengthening as we saw a very strong CPI print, the underlying printing at 2.6% versus 2.1% expected, and the headline all the way at 3%. I've got a chart here showing that this is coming at a good time for NOK bulls, or maybe a little bit too late for those who got squeezed out on that little run up above 984 on Friday. We've also got other news that I'll get to you all in a sec on their oil fund. They're very interesting there, but technically very interesting for NOK bulls that we have this reversal back below the 984 level and a pretty strong follow through. So this is a place to get established on the short side, I would expect, now that we have a pretty clear technical situation for Euro-NOK. Ola, the big news, of course, late last week was that the Norwegian pension fund is going to divest itself of a lot of its fossil fuel assets. Yeah,
it created a lot of headlines on Friday that they finally decided, or because it's been in the pipeline since 2017, that because Norway is obviously their main income is coming from oil, and by the same time having their revenues or investments in oil obviously leave them double exposed if we should see lower oil prices over the coming years. So that led to this decision to cut some of their holdings. But at this stage, it's a relatively small impact. They got around $37 billion worth in oil and gas companies, and initially they're only going to cut something like $7.5 billion, but it did create obviously some stir in the market. They have huge amounts of holdings, so it will take some time to unwind. But overall, we saw the XOP, which is one of the big oil and producers ETFs. It dropped on Friday, but more or less in line with the price of oil. So, but it's going to create some.
Yeah, they're not going to want to shoot themselves in the foot, I wouldn't think, and try to get out of it on one day.
They're not going to dump it overnight.
No, okay. And then lastly, on the commodities front here, before we get to our calendar, you have a couple of notes on oil and gold.
Yeah, just again because we've been deprived of these numbers for a while. If you look at the chart here, the table, we can see the yellow line. That's the net position in crude oil in both WTI and Brent. It has been picking up since we recovered from the lows in December, but it's been quite a muted recovery. So it does still indicate that the market is not all guns blazing, running back into a roaring bull market, and we can see the market is still concerned about the economic outlook, which is keeping some bulls at bay at this stage. And just on the right there we see the gold. The yellow line is the fluctuations, the net long, and hedge funds really had a horrid time here over the last month. They filled up just ahead of the failed attempt to break 1350, and then last week they capitulated. There was a lot of selling just ahead of that week number on Friday. So let's. I think at this stage, gold needs to move back above 1306 before we see the market start to calm down. And at this stage, we're trading below 1300 this morning.
Right, we did see a bounce on Friday, but it hasn't extended above that key level just yet. And remarkable, really, on the oil positioning that it's so very low compared to where it was back in 2017.
Yeah,
and that's very interesting. All right, let's look at our macro calendar this week. I have not talked about sterling, which is going to be the FX focus for this week. Terrible uncertainty around sterling this week. We have the supposed vote on May's deal tomorrow. The latest noise is, if we're to believe the headlines, that this deal is headed for a failure in Parliament. Could lead to a delay. Supposedly they're going to be trying to achieve a short delay I don't see how that's possible. I don't see how anything can be decided in a short delay that couldn't be decided over the last 2.5 years post this Brexit vote. So I suspect that this is a wedge towards opening up an eventual longer-term endgame towards a second referendum. Could also mean the end of May's time as Prime Minister. But I simply don't know, and I think the market is very uncertain. And I think the risks generally leading, even with a delay, potentially leading, even if we do get a knee-jerk reaction and a rally saying this is good news, perhaps this leads to a second referendum and a Remain vote long-term. Any extension or this idea that we open up a longer delay, I think leaves the UK economy suffering. It leaves lack of investment into the economy until we know what Brexit or not looks like. So that my thinking has switched a bit on sterling. I'm a bit more cautious. But let's get to the calendar specifics. We've got January retail sales, perhaps a bit more interesting than usual after a very ugly December print in the U.S. U.S. Fed's Powell is out speaking. He was out speaking twice this weekend. There's been no reaction to the outlook there. I think we're all waiting for what patience means from the Fed, and we're waiting for their assessment of monetary policy and how they're going to change the goalposts there. So I think short-term signals are going to be few and far between besides data prints. Then we have the Australian NAB business survey overnight, CPI from the U.S. tomorrow. But again, these Brexit votes, we'll be focusing on that as we hit those, and potentially maybe not even hit those, because there's even word that those votes could be delayed, I suppose, a few days. But let's see. And that's the rest of the week there, and then we have the FOMC next week. That'll do it for today. We'll be back tomorrow with the Saxo Bank Morning Call. Thanks for joining.